All right, how's it going, everyone? My name is Scott, and welcome to my channel where I'm here to help you learn how to trade, invest, and master your finances so you can apply that knowledge in the real world and multiply your money. And today's video is my next episode of my live option trading series where I'm going to show you all the trades that I made over this past week. And so specifically in this video, you're going to see some new trades I put on in Virgin Galactic. Once again, I'm not giving up on that stock. Also in XBI, Micron Technology, and Bed Bath & Beyond. And then after that, I'm going to walk through every single position in my portfolio so you can see where everything is at right now today. But as always, before we get started here, for those of you who are new to the channel, I just want to let you know that I do also teach on Skillshare, where you can take my very in-depth classes on options trading and stock market investing. And I provided some links to some of the introductory courses of mine in the description of this video below. So be sure to check them out. And when you sign up for Skillshare using any of those links, you'll get a 2-week free trial. Okay, so with that being said, I'm now going to go ahead and play a few clips that I recorded this past week that will show you all the new trades that I made. Okay, today is Monday, June 28th, and here I am once again taking a look at Virgin Galactic. And if you saw my previous video where I talked about how terribly my previous trade on the stock went, you might be thinking, why in the world am I trading the stock again? And it's simply because that previous trade is done with. It was a bad trade, or at least the outcome of that trade was not great. But now I have the opportunity to totally reset here, put on a brand new trade, new strikes, and also implied volatility is much higher than where it was on the previous trade, right? This massive move higher we saw on Friday, June 25th, this 40% up move is what caused implied volatility to explode. And as an option seller, as somebody who sells options when implied volatility is very high, I really cannot pass up this opportunity. Although I will say if there were other stocks on my watch list that were also exhibiting very high IV, then yeah, I would probably go with those other stocks. But as of right now, implied volatility is pretty low across the entire board. This is one of the very few stocks right now that are still exhibiting very high implied volatility. And even if you come into the July expiration cycle, which only has 18 days left to go, just take a look at the prices of these call options and these put options. They're still very, very expensive. So this means I can sell options super far out of the money, give myself a very high chance of making a profit while still collecting a pretty decent credit. So in order to capture or take advantage of this very high implied volatility, which I view as a very short-term thing, and in fact right now you can already see the implied volatility coming down today, so I do expect this to continue over the next few days and 1 or 2 weeks here. So basically I'm aiming here to just make this a very, very quick trade. I just want to take advantage of this quick contraction in implied volatility and then get out. So coming back to the trade tab real quick here, as you can see, I'm considering selling the 80 strike call option along with the 42 strike put option. So this is a bearish skewed strangle. And I definitely do want to lean bearish here because, one, the stock is so sky high at the moment and stocks will eventually come down. And also if you look at the RSI indicator, which tells you how overbought or oversold the stock is, you can see as of right now, it's indicating that the stock is very overbought. It's at a very lofty price. So that's why I want the delta on my call option here, which is 21, to be larger than the delta on my put option, which is 17. So let's go ahead and set this order here just so I can see what the credit looks like. And perhaps I still will change my strikes. We'll see. So it's going to be the sell 1 contract, 80 strike call option, sell 1 contract, and the 42 strike put option. There we go. $372 of credit. And I'm just curious to see what would happen if I came down to the 75 strike on my call option. So now I'm over $400 in credit, and the delta on the 75 strike is 24. It's a bit higher. And you can see on the charts here just how far away 75 is from the current stock price. So I think that's where I want to be. And so with that being done, let's come over to the confirm and send here. Take a look at the buying power effect on this position, about $1,000. That's fine. So we'll go to send and see if we get filled here. Not filled quite yet. Let's come back to the monitor tab and take a look at what's going on here. Okay, so my limit price is 406. The mark price for this whole strangle is 405. I'll come down a few pennies. I'll come down to 404 maybe, see what happens here. Send. Actually, there we go. Just got filled at 404 exactly. Very nice. And so of course, the last step here is to place my automatic closing order to take my profits. So now we're going to buy back 1 contract, the 75 strike call option, and then also buy back the 42 strike put option. And I'll do it for half of the maximum profit. So that's going to be $2.02 on a per share basis. Make it a GTC order, confirm and send, there we go. So definitely a little bit of a risky trade here, given how badly my last trade went on Virgin Galactic. But like I said, again, this is a brand new position. Implied volatility is even higher, so my strikes are even further away. I'm also just doing one contract this time, not two contracts, and it's also a strangle. So this is a very different kind of position, and there's also only 18 days left to go until the expiration date. So this stock is going to have to explode by another 50% just to get up to and test my call strike. And also it would have to fall by about 20% to the downside just to get down to and test my put strike here. And this would be on the heels of this stock already being down about 5.7% today. And one more quick thing I want to mention here. Also this morning, I took off my Roblox naked put option for a profit. Right, let's come back to the charts real quick here. Go to RBLX. Let me expand this down a bit so you can see the charts a bit better. There we go. So it was during this down move where I wanted to sell naked puts and get bullish on the stock. Now I did not get the timing correct. It was actually at this point where I sold those put options, or that one put option, and the stock did continue lower after that. So of course that was a bit frustrating, but sometimes patience is the best solution in a losing trade, and that's exactly what I did. I just was patient, didn't do anything, made no adjustments, and then over the next few days, and especially this morning, the stock absolutely exploded. So it was this big move this morning that allowed me to take off that put option for a full profit. All right, today is Wednesday, June 30th, and what I have pulled up here is a one-year price action chart of XBI, which is a biotech ETF. So as I'm sure you can imagine, because of COVID, this ETF was skyrocketing for the better part of the last year. Right, obviously there's a lot of hype around pharmaceutical and biotech companies as they're trying to do research and find cures or vaccines for COVID. But in the past few months at least, this ETF has sold off pretty significantly after its peak at around $175 per share. And so I've actually been waiting to get long on this ETF for quite some time, and today I have done just that. So specifically what gave me the confidence to sell a put credit spread on this ETF, I did not do a naked put, and I'll explain why in a minute. But I do like this basing pattern that we're seeing here. Now, I'm definitely not a pattern-based trader. The vast majority of the trades I make are based purely off of implied volatility and probability. But that being said, I do like to still incorporate a little bit of technical analysis. And there are also a few basic patterns that I do keep an eye out for as well. This being one of them. And that's due to the fact that I've seen this many times before. And oftentimes what this means is the stock is now recovering from its recent sell-off. And I do think this recovery will continue for quite some time. Where typically what you want to see in terms of a completion of this entire pattern is for the stock to come all the way back up to the previous high. Now, of course, this is a slow moving ETF, so it could take a lot of time for it to go from 135 where it is now all the way back up to about 175. But point being, I am bullish at least in the short term on this ETF. And so typically what I would do is sell a naked put option on a stock or an ETF that I'm bullish on, but because of two reasons. One, this ETF is pretty expensive, right? Like I said, the current price is $135 per share. And then on top of that, the implied volatility is not that high. I was waiting for some spike in implied volatility. That's what we're seeing right now. But still the IV rank is at 31%. That's not bad, but the IV percentile is only at 15%. Which basically means that only 15% of days over the past year had an implied volatility less than where it is right now. So even with this spike, IV is still on the lower end, at least considering the past year. And so that's why I did not want to have too much risk on. I did not want to sell a naked option. So as a result, that's why I sold a put credit spread instead. Basically sold the 135 strike put option and then also purchased the 125 strike put option. So this is a $10 wide put credit spread. I sold this spread for $332 in credit. That's not bad. So my risk on this trade, the max amount of money I could lose in the worst case scenario would be $668. So again, just trying to keep my position size extra small here, mostly because the implied volatility for XBI is pretty low still. Now, one other trade I do want to mention briefly here, and this is a trade I put on yesterday, which would have been Tuesday, June 29th, and that was in Bed Bath & Beyond, which is BBBY. And I do apologize for all the stuff going on here in the price action chart, but essentially all I did here was play the earnings announcement. Bed Bath & Beyond announced earnings this morning. And so yesterday, right before the market closed, I sold a bullish skewed strangle. So I sold the 43 strike call option and also the 27 strike put option, and did so for about $340 in credit. And so when the market opened this morning, this was basically a perfect trade. And that's because after those earnings figures came out this morning, Bed Bath & Beyond was only up by about 70 cents. So I was expecting implied volatility to absolutely collapse. And it was in the process of doing that when out of nowhere, the stock literally skyrocketed all the way to $39 per share, which was about a 30% increase. I have no idea why. They didn't even beat earnings expectations. This move simply came out of nowhere. It was very bizarre. Now, thank goodness, the stock has come back down a lot here. It's now only up by about $3.80. So I believe this position is still profitable. Let's go in and check. Yeah, I'm up about 48 bucks or 40 bucks right now. But it was actually down almost $200 when the stock decided to explode by about 30%. So a little bit freaky there, but the stock has come back down, like I said, and now it looks like implied volatility is starting to contract. So just going to hold on to this trade for a bit longer. I am in the August expiration cycle, so I can hold this trade for quite some time. So that's what I'm going to do. Now, I just want to say that normally when you play an earnings announcement, specifically when you sell options around the stock right before those figures come out, and also the stock doesn't go anywhere after those earnings come out, then I would say almost 100% of the time, you will see implied volatility collapse that following day, and that will make for very quick profits, especially if you sell options in shorter term expiration cycles, maybe a few weeks out, as opposed to about, I think, a month and a half for this August expiration cycle. But trading earnings announcements is one of my favorite things to do because implied volatility is typically very high beforehand, and then, like I said, afterwards, as long as the stock doesn't skyrocket or absolutely plummet, you can oftentimes make a pretty quick profit because implied volatility contracts so quickly thereafter. Okay, welcome back. I hope you enjoyed those few clips. And so now I want to go over our current positions and see where we're at. So beginning first with our STX position, this is Seagate Technology. So I'll come back to the charts here real quick, and I already have it pulled up. And so if you recall from last week, this was the stock where I sold a naked put option, mostly based on this support level right here. So specifically, once the stock got down to this point, I think it was on this day where I sold that put option. Because my assumption here was that we would at least get a short-term bounce going forward. And so far, that's exactly what's been happening. Now, the stock is coming down a little bit over the past 3 days or so. That's fine. But I definitely would like to see a lot more follow-through going forward. Follow-through to the upside, I mean. And so this short-term bounce combined with the fact that implied volatility has dropped a little bit since then, since I sold that put option. That's why, as of right now, overall, I'm up on this position by $165. And in fact, actually, I think the stock is down today, right? Okay, it's basically up by 6 cents, basically unchanged. But either because implied volatility has contracted today or simply because of time decay, I'm still up 26 bucks just today. And again, that's from the stock being completely unchanged. Very cool. Now, what about TAL? This has been a troubling position since pretty much the day I put it on. Right, let's come back to the charts real quick. Go to TAL, and I'll zoom in a little bit. And so I think it was around here where I sold those 2 naked put options, right when the stock was around 38, 39 bucks per share. And then obviously, as you can see, the stock has just plummeted ever since then. And because of this huge drop further, implied volatility has actually gone nowhere. Right? Typically, when you see implied volatility get to this level, get this high, you most of the time see very soon after implied volatility contract all the way back down. But if the stock is just crashing to the downside or just exploding to the upside, implied volatility is not going to go anywhere. In fact, it might just continue to expand, and that's going to be a bad thing for option sellers. Now, there is still about 2 weeks left to go until the expiration date. Yes, as you can see here, I am in the July expiration cycle, 14 days left to go. But now you can also see I am short 2 naked call options at the 37.5 strike. And so the reason why I did this is to take in some extra credit, some extra premium, because I was suffering some losses by having to hedge my naked puts over here by repeatedly shorting shares of the stock. Right, because as the stock went further below my strike price here at 35, the further it goes, the more shares I will short. But if TAL starts to bounce and move back higher, I'm going to have to buy those shares back, basically remove that hedge, and do so for some losses. Now, those losses are pretty small. They're only about $100 every single time I do that. And I mean every time I have to short and then eventually buy back shares. And so eventually, if I lose enough money, then I will have to make a different kind of adjustment, specifically selling call options, right? Because let's say I lose $100 from trading the stock over here to hedge my put options. But if I sell these call options for about $100 in premium, then if these options expire out of the money in 14 days, then those two things will totally offset. I lost $100 on the stock, made $100 by selling these call options. The net effect is I don't make or lose any money. And so at this point, I'm currently short 150 shares of TAL, and we'll see what happens over the next 2 weeks. If this stock just keeps continuing to plummet, then I might have to short 50 more shares and make it 200, in which case I would be completely covering my put options here, right? I'm currently short 2 naked put options. So if I'm also short 200 shares, that means these put options are now fully covered. So we'll see. Now for XBI, this was a put credit spread position. So let's go to XBI real quick. Now this position is very, very new, so not much to say here, but today the stock is down a little bit by about 1.3%. So of course my put credit spread position is losing money today, but I'm still very bullish on this ETF for the long term. Right? Basically, if I go to my drawing tools real quick, let's go to a trend line. I'll just click and drag up here like that. There we go. And then let's go back to the regular cursor, zoom in. So as you can see right now, this ETF is respecting this trend line very, very nicely. So of course, there can be down days and some big dips here and there, but overall, the trend is still moving higher. So definitely not worried about this position right now. Let's come back. Now, Virgin Galactic again, this was a new position I put on a few days ago after my naked calls got totally blown out. So let's go back to SPCE. And this stock is just incredibly volatile at the moment. Let's zoom in a little bit here. So after this massive explosion by over 40% in just one day, the stock came right back down very quickly. And then today, boom, it actually opened about 25% higher and now it's selling back off again. I don't know what this is, why this is happening. It's pretty crazy stuff. And of course today with this big pop moving higher, implied volatility is also expanding. So this is one of the few rare cases where when the stock moves higher, implied volatility also expands. Usually it's the reverse. When stocks sell off, that's usually when you see implied volatility expand. Because if you recall, this is an indication of how much fear or uncertainty there is in the market. And typically people get more fearful or more uncertain when stocks sell off. But in cases like Virgin Galactic, where the upside velocity is just so intense sometimes, there's actually a lot of uncertainty and even fear about what the stock might do to the upside. So this expansion in implied volatility alone is actually why I'm down on my position today. If I come to the trade tab real quick and scroll down, you can see I'm short the 42 strike put option and the 75 strike call options. So my options are still very far away. They're both out of the money, and yet coming back to the monitor tab real quick, as you can see here, I'm currently down on my space position by about $120 just today. And again, that's only from implied volatility. So definitely a bit annoying, but not a big deal at all. So nothing to do here. Now Bed Bath & Beyond, this is looking very good now. Let's come back to the charts, go to BBBY. So this was an earnings play I made a few days ago. I'll zoom in a bit more actually. So this was the day that earnings came out, this massive pop higher. I'm not sure what was going on here because the stock actually opened. It opened after those earnings figures came out, literally 7 cents higher, just 7 cents. But over the course of the trading day, it went up all the way to about $40 per share. So from 30 to 40 in just one day and then right back down. And now, over the past 2 days, it's coming back down even further. So basically at this point, the stock is pretty much back to where it started, just a bit higher. And combined with that, we're seeing also a contraction in implied volatility, which almost always happens after an earnings announcement. And that's why I made the trade. So nothing to do here except to be a bit more patient. If I come to the trade tab real quick, and I'm actually in the August expiration cycle for this position. This is a strangle. So both my put and my call option are still very far out of the money. And like I said, at this point, it's just a matter of waiting a few more days, letting time decay and implied volatility continue to work. And then at that point, I can hopefully take the trade off for a full profit. Coming back. And finally, we have 2 more strangles on CLNE and MU. So CLNE is a position I've had on for a little while. Let's go to the charts here real quick. This is also a strangle, like I said. Specifically, I'm short the 11 strike put option and the 21 strike call option in the July expiration cycle. And so far, in terms of my directional assumption, I'm not doing so hot on this position. I was expecting this stock to continue moving higher, but as you can see here, it is actually moving lower and is now below my strike. But look at this contraction in implied volatility from 160% all the way down to 95%. So even though my put option is in the money, I'm directionally incorrect on this position, at least so far, and yet, come back to the monitor tab, this is still a profitable position overall. I'm up about $86. So once again, a powerful demonstration of how effective selling high implied volatility can be. because even when you get the direction incorrect, if implied volatility contracts, which most of the time it does, that can totally offset you being directionally wrong. Now, of course, it will only help you so far. If CLNE continues to just drop further, down to $8 per share, 7, 6, and below, then eventually I would see losses on this position overall, but definitely still a great example of how powerful implied volatility can be for your option positions. But at this point, the stock has not breached my put option far enough for me to do anything. In fact, even if the stock were to expire at this point, if today was the expiration day and clean energy expired at $9.90 or so, I would actually still walk away with a profit because the stock is still within my break-even points. And this is a very powerful thing when it comes to options selling, because instead of buying an option, having to pay money to get into a position, in this case, you are selling options and you're taking in money initially. You take in a credit and you can always use that credit to offset losses. So in this case, my break-even point is all the way down to about $9 per share. So as long as by July 16th, as long as clean energy stays above $9 per share, I will at least break even on this position. No big deal. It's only below $9 per share where I will actually encounter losses. And then finally here, I have my MU strangle, which is a pretty new one. I don't think I was able to record this one either, and I do apologize. This was a very busy week. So coming back to the charts, go to MU. This is Micron Technology, and this is also an earnings play. And a second great example of getting your direction incorrect, at least for the time being, but implied volatility still saving your butt. So in this case, I sold coming to the August expiration cycle, I sold the 80 strike put option, which is just ever so slightly in the money at the moment. And then also the 97.5 strike call option. I sold the strangle for about $415 in total credit. And so back to the charts here, and I'll zoom in a little bit. So once those earnings figures came out right here, on June 30th, the stock immediately moved lower. And so because I sold a bullish skewed strangle, this directional move obviously worked against me. I am bullish on this stock because I do think this basing pattern will continue in the sense that over the next few weeks, I do think this stock will start to rebound and move higher from here. But like I said, in the immediate short term, I am directionally incorrect. However, because this was an earnings announcement, look what happened to implied volatility. Boom. It totally collapsed. So because of this, once again, let's come back to the monitor tab. And at the moment, I'm only down in this position by $20. Not a big deal at all. And in fact, today I'm actually up by $16.50. And the stock, I believe, the stock is actually down today by about 1%. So the stock is moving against me, and yet I'm actually making money today. That's very cool. And this is something that you will never, ever be able to see or be able to take advantage of if you are just trading stock. In the world of stock or futures, any totally static financial product, you must be directionally correct to make money. You buy a stock at a price of $50 per share, the only way to profit on that position is for the stock to move higher. And the moment the stock drops 1 penny below 50, you're now losing money. Options are not that way. They're very dynamic, and there's a lot of different ways to actually make money with options. So that covers all the current positions I have on in my portfolio. I don't think I've done this in any of my recent option trading videos, so that's why I wanted to do it today. And also because I don't believe I'm going to put on any new positions right now. And that's partially because I already have, I think, 7 positions on at the moment. And actually, let's come back to the charts real quick. Take a look at the VIX futures. And yeah, exactly. Implied volatility is just going lower every single day almost. The VIX futures are just below 17. And in case you're not aware, the VIX futures contracts or just the VIX index, either one will work, will tell you what the implied volatility is for the S&P 500, which is basically the bulk of the market. So in other words, this basically shows you how much fear or uncertainty there is in the entire marketplace at the moment. And as you can see here, there is very little fear or uncertainty. Implied volatility is very low, which means options are very cheap across the board. And when options are cheap, I'm not going to be very keen to sell them. But still, just in case, I will come back to my Market Watch tab and I'll scan through my list very quickly here and see if I can find anything new to trade today. Okay, so I'm back here and yeah, as I expected, could not find any stocks today worth trading. Implied volatility is just simply too low across the board, and the few stocks that do still have high IV, they pretty much all have earnings coming up very soon. So I'm going to wait for those earnings dates to actually come up. And in case you're wondering why implied volatility is so low across the board right now, let's come back to the charts, go to SPY, and I'll zoom in a little bit. And this is your answer. We've had pretty much 1, 2, 3, 4, 5, 6, 7 up days in a row, one tiny little down day, and then 2 more big up days preceding that. So this market has been moving higher almost every single day for about 2 weeks. And when something like this happens, when the market just grinds higher, all fear, all uncertainty goes out the window. So again, because of this, I want to wait for some implied volatility to come back into the market, ideally when a sell-off occurs, and I would imagine that's going to happen pretty soon. And at that point, I'll jump back in and start making more trades. So with that being said, that's going to do it for this video. I hope you enjoyed it, and please let me know your thoughts or if you got questions in the comment section below. And don't forget, if you want to take some very in-depth classes on options trading and stock market investing, then check out my Skillshare courses. Links in the description of this video. And finally, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every single week, and you don't want to miss out. So thanks again for watching, and I'll see you next time.